Good morning, everyone, and good afternoon for our listeners in Russia and CIS. My name is Andrew Podgiersky. I'm chairman of the board of U.S.-Russia Chamber of Commerce and also partner with the law firm Louis Brisbois. Would like to welcome all our members of the chamber and also partners of the chamber and our guests to join this event, the Energy Dialogue. A couple of words about the chamber. USRCC was founded 12 years ago and is headquartered in Houston, Texas, the energy capital of the world, and also have the representative offices in New York and Chicago, and organizes about 20-30 events per year. A number of them are energy related, from senior executive speaker series to procurement and supply chain seminars, ministerial speaker series. USRCC actively participates in Offshore Technology Conference, NAPE, works closely with GasTech, participates in Neftegas, Tumen Oil and Gas Conference, as well as LECO and MIOGI. Based on what has been happening in the world, and especially with the elections in the United States, we thought that would be of great importance to our audience to hear from the speakers in the US and in Russia, who are well known in both countries and also understand the subject of energy in both countries. With that, I would like to introduce our moderator for the panel, John Gibson, and John is a president and CEO of Flotech Industries. John?
Thank you very much, Andrew. We do have a mediocre moderator and 4 outstanding speakers today, so I'm glad that they're going to be carrying the weight for this program. We are going to go through and have short presentations from each one, and I'll turn it over to them just a moment, and they'll take us through that. At the end of that time, I have a few questions that I'd like to ask, and then we'll get the audience to jump in and ask the really hard questions. But we're very fortunate to have, and we'll just introduce each one as they come up to speak. We're going to start this morning with Mark, the CFO and Deputy Chairman of the Management Board for PAO Novatech. Just an outstanding company who have sort of conquered gas production at this point and become a major player in the world. And so with that, Mark, I would like to just turn it over to you and say you're a highly recognized CFO in Russia, and we're just delighted to have you.
Well, thank you very much, John. And Andre, thank you very much for the opportunity to speak today. What I'd like to do is essentially talk a little bit about Novatech and some of the things that we're doing as a company, because as John mentioned, sometimes people don't really understand the size and scale of the group. And over the years, we have built a business that's quite large in relative scale to the oil and gas industry. Okay, just a glance at what the company looks like, and I just want to highlight a few things. I mean, as a company, we're the 3rd largest holder of natural gas resources in the world. So we operate off of 66 licenses. And last year in 2019, we produced the equivalent of almost 79 billion cubic meters of natural gas, which is roughly 2.8 trillion cubic feet. And in terms of on a daily production, it's about 7.8 BCF per day. Next slide, please. What I'll talk about a little bit is what our role is in the LNG world. This slide essentially shows that we anticipate, despite what we see at the pandemic this year, that natural gas in the form of LNG will double to more than 700 million tons by 2040. And this represents about 88% incremental growth from both Asia and Europe. And as you can see from this particular slide, the majority of this particular growth will come from the Asian market. Now, we have people that talk to us all the time about whether we're a little aggressive in terms of the demand growth. But one of the things, whether you look at it 600 or 650 or 550 or 500, we've seen a whole range. One thing that we're absolutely certain is that Novatech supply will be part of that production. Next slide. So actually, I didn't get a chance to change this slide because I just got a message this morning that we do now have our first FID in 2020, with Sempra just making the announcement yesterday. So it's with pleasure that we will not go a decade without any FID decisions. But we really put this on because last year, 71 million tons addition, we represented about 36% of that number by the launching and taking the FID decision on Arctic LNG 2, our second large-scale project. But the most important thing I just wanted to talk about this slide is that given a 5 to 6 year construction period and the lack of FID decisions, and if we look at the demand growth of whether or not we believe gas will grow 2% per annum, LNG will be about 4% per annum, we have a potential for a supply squeeze post 2025. This corresponds mostly when we start launching our next construction project. So it's something to watch as we start looking forward in the mid of this decade. Next slide, Lena. Despite the pandemic, one of the things that is unusual is that we have seen relative growth this year for the first 10 months, 4%, and led by about 11% growth in China, a little more than 20% growth in India, which is 2 of the largest markets. So despite the fact that maybe this is lower than pre-COVID numbers, it is positive in the sense that we have grown year on year. And I think it's anticipated that we'll stay about 3 to 4% growth in LNG demand for 2020. Next slide, please. And this slide I just wanted to highlight a little bit because this really differentiates some of the business models. And I use the US LNG, particularly FOB Gulf Coast, as a comparison to our Yamal LNG project, which is FOB Sabetta. As we can see on the bottom line, our FOB cost comprises about 7 cents per MMBTU for gas delivered into the plant and just under 43 cents per MMBTU for the liquefaction process. And this compares to $2.90 or full cost FOB Gulf of $5.90. So you see in a relative range is that, you know, our gas coming to the market is one of the lowest landed LNG costs in the world. And the other thing I want to know, because when I go to the next slide, you see the big drop off in gas prices over the years. And when we saw the low this summer, and spring summer, I would say we probably hit the low, we reached about $2 JKM, which is a Japanese Korean marker, about $1.48 for Henry Hub, and roughly about the same for TTF. And as we see the year moved on, as we started getting into the winter months, we've seen a nice recovery in natural gas. So as we go into the winter months, what we're anticipating is a stronger pull of natural gas, hopefully a more normal winter weather, and so we can start getting back into sort of the normal periods of seasonal withdrawal and fill. Next slide. And as a result of this particular scenario that we saw over the year with the prices, this slide really tells a picture of how the United States actually served as a balancing factor for LNG globally. What I want to say is if you look at the top line, you know, Novatek operated all year. So our Yamal LNG project operated at about 113% throughout the whole pandemic period. If you look at the black line represented the US liquefaction capacity utilization for this particular year. At its low point, it reached about 41%. At the end of the third quarter, it was roughly about 56%. And you can start seeing that it's trending upward in the 70s now. And we expect that it'll be fully recovered by the time we hit the end of the year and the winter months. But it was interesting is that this particular period represented really the first time we saw a massive amount of cargo cancellations, whereby the buyers elected not to take the cargoes that they secured, and we had about 165 cargo cancellations. Now, this is not a supply-induced, you know, sort of shortage. This was actually a buyer's, and we believe that this will cure itself as we go into the winter months. But if we don't have a seasonal winter weather, we might repeat the same pattern as we saw in 2020. Next slide. And so this is just Novatek's platform. We plan to produce up to 70 million tons by 2030. We've already fully operated at the Yamal LNG plant, and we're now in a construction phase of Arctic LNG 2, exploration phases in Arctic LNG 1, and eventually Arctic LNG 3. So we're basically doing a bunch of exploration area, but this area has about 4 trillion cubic meters of natural gas. So it gives us plenty of opportunity to build out a platform that goes beyond the 70 million tons, but this is what we have into our most recent strategy period. Next slide. And so now just a quick word on Yamal LNG. It's been the fastest project to reach 500 cargoes globally. As I mentioned, it's operated so far 113%. We have more than 550 cargoes for more than 40 million tons. This was one of the projects that we had many doubters, skeptics, and critics about whether or not we can build this type of facility in the Arctic zone. And we managed to not only build it ahead of schedule, but we managed to build it on budget. So it really today represents the gold standards. And now we're in the process of launching train number 4, which we expect to have the construction by the end of this year with commissioning starting in the next few weeks. Next slide. And now we go to our next big project, which is the Arctic LNG 2 project. It's roughly about 20 million tons. We expect the first train to be launched in 2023, second train in 2024, and the third train in 2026. This is on schedule. Overall progress for the first train is about 39% as of the third quarter. Total project is 27%. We have already drilled about 24% of the wells needed, production wells, to launch the first LNG platform. And this actually is a little different than what we see in Yamal. This is where we're going to build what's called the gravity-based structures, where we're actually moving stuff off onshore and put it in these large vessels, and everything will be self-contained. So we're actually eliminating and reducing our carbon footprint in the Arctic zone. Next slide. One of the things that was obviously important for us is the logistics side of our business. We use the Northern Sea Route to take products to the Asian Pacific market, or if we have to go westbound, we end up going through the Mediterranean, the Suez Canal, and up through the Indian Ocean, Strait of Malacca. Big difference, by going the Northern Sea Route, we reduced the transit time by 50%, as well as the nautical miles. And as you can see from this particular slide, relative to other competitors around the world, we have a pretty good footprint to actually deliver both east and westbound. We're in a process right now of doing our first ship-to-ship transfer in Murmansk, which will be a vessel-to-vessel. We've done that previously in Norway. Now we're moving it to the Murmansk region. We're also just ordered 2 vessels that are in the construction phase that will build 2 transshipment facilities, one in the Far East called Kamchatka, the other in Murmansk. And at this particular point, we will then use those facilities to set a new benchmark price in the Asian Pacific market. But we're competitive to be able to deliver all these regions, and Novatek's molecules have made it so far to 29 countries. Next slide. And just one word on emissions, because I know we'll probably get to some of the carbons, is that we've demonstrated already as a company that's highly gasified. We have more than 85% of our output is natural gas, and we ranked the lowest in greenhouse gas emissions by sustainability reports, et cetera, comparing ourselves to other companies. Next slide. And just recently, we launched, we're the first Russian company to do this. We actually set our environmental targets to the end of the strategy period 2030. And we outlined, we used 2019 as the baseline. And as you can see, we don't really have to move much in terms of reducing because we're already the lowest in the industry. But I'd like to just end with saying that we have issued 13 sustainability reports, and if ESG, environmental sustainability and governance is important to you, I would recommend that you go to our website. We have a very, very detailed reports and presentations on what we're doing in this important area. Okay, with that said, I am done. So thank you very much, everyone.
Very much, Mark. An excellent presentation. For those that don't really realize the importance of Novatek in terms of global gas production, it's a great presentation as an introduction. I think particularly in the U.S., people may or may not really recognize that name, but I think they will going forward. Our next speaker is Cedric Kremers from Shell, and he has the credentials of a Shell person who's taken on all the really tough assignments to include Nigeria and Houston. and has worked his way through also with a financial background, and is currently serving as the country chair for Shell Russia. And Cedric, we look forward to your presentation.
Thanks, thanks, John. Can I just check if you can see the slides?
We can.
Very good. Thanks. Okay. So just a couple of maybe adding to what Mark's already shared, some reflections about where our industry is and where we need to go forward. I think if I would say just a year ago in similar 4-hour different places like this picture here, I was saying, you know, as always, we talk about different scenarios, opportunities, challenges, risks, options, and all of these things about that our industry faces. But probably, you know, when we would have been having something like this a year ago, one of the clear things that would not have been on our radar screen, or at least I didn't hear very many people talk about it, was a planet-wide pandemic. And I think we can certainly say that since that time, we've entered into an unprecedented time of rapid and difficult change for all of us, you know, in terms of how we lead our personal lives, but also, you know, in the energy industry, in terms of having to reinvent many things that perhaps seemed routine and almost unchangeable before. And I think I probably speak on behalf of everybody here on the panel that the key priority within that has been keeping our employees, contractors, and communities and everybody around us safe where we can. Let me just, you know, reflect on a few things that have had to change. You know, we've had to change our protocols of working, whether in the field or in the assets. We've had to adapt to being physically isolated from our assets and our companies. And as Mark already shown in some of his slides, also navigate through increased market volatility, shrinking demand, etc. So I think this has certainly, you know, highlighted some vulnerabilities. But what I actually want to talk about is the opportunities, that how we've had to change during this time period. If we hold on to that change, how it can ensure that as an industry we end up coming out stronger out of this crisis. So what do we need to do then, perhaps as an industry? What can make us stronger? What can help us be more resilient to address these changes? And I just want to touch on probably 3 areas. And maybe as you look along with these, you'll see the words D, E, and C come back at different points in time. So maybe a nice metaphor for it, that these are the different vitamins that we need to keep our industry strong, similar to how we need to keep our bodies strong and ourselves during the current COVID crisis as well. So the first one is around digitalization, and in some ways this is a fashionable word, but I think it's an instrument that's been around for some time in our industry as well. You know, whether it's from smart wells, smart fields, subsurface modeling, and it's been around for quite some time in our industry. However, if we look at the last months of operating and lockdowns and all these other restrictions, it's not just become a nice to have anymore, or an area of how shall I say, maybe competitive advantage, but it's been existential in order to even survive, how you use digital tools. So, you know, how to also be able to do work remotely, because people can't come to the working place anymore because either they couldn't travel to the destinations where their services are required, or other restrictions that they had. A small example is one I wanted to share, where just a couple of months ago, I was able to visit the Sakhalin 2 LNG plant. This is in the south of the island of Sakhalin in Prigorodnoye. During the middle of their major annual turnaround, and I actually was able to do that virtually, and you know, see all the activities that were happening, and talk to both our staff and contractors there to discuss the work that they were doing. So what you see here on the screen is kind of, if it's animated properly, but is my avatar. So I was sitting in my Moscow residence with a RealWear remote communication helmet on my head in my room, and then, you know, somebody that was walking around the site with the same helmet, you know, looking around. I could see what he could see. I could hear what he could hear, importantly, and others around him could hear what I was saying. And it was actually quite a unique way to be able to collaborate with people thousands of kilometers away in an operational site. But you know, if I think about this, then you know, it's perhaps, you know, nice to think about it for somebody like me to do a visit, and you know, maybe something that's nice as management. But what I actually think is even more critical, and here you see other pictures of the same, is that this was used by hundreds of people that actually had to be involved in this turnaround, and that would normally have been on the location. For example, OEMs and different equipment suppliers that would have been doing their on-site certification of the equipment that was being replaced and installed, and all these kind of things were done remotely, with actually because of the timing when we had the turnaround back in May and June, we weren't able to bring any foreigners into Russia. And so it was done 100% with local workforce and with experts abroad, all doing this this virtually. So I think this is the type of one area, the D for digitalization, that I think we should hold on to from what we've learned in this period and make ourselves stronger. The other one, the next one, so call it vitamin E, is around environmental sustainability. Again, building some similar points that Mark touched on, but I think we also see the energy transition that's happening right now, and that allows us to go to a lower carbon footprint. So I just wanted to perhaps reiterate a few points here. You know, as I think the world goes through to a lower carbon future. I think especially continuing to invest in gas is really critical. Now, you know, you know, I think there's a lot of talk about new energies or different energies that might be, you know, zero carbon to start with, but I think the transition that we need to go through is unrealistic over the next decades without relying heavily on gas as the lowest carbon hydrocarbon. And that's not only for maybe the more traditional things we all think about, such as power and transportation, but also very importantly for the harder to electrify sectors of our economy. You know, where you simply need that higher energy intensity, and you know, the opportunity to also substitute both coal and diesel today. Now, the thing though that I wanted to share is that what we do see though, and we have seen this even accelerate in the last year, is the demand from our customers. And so I'll continue to talk a little bit about LNG to deliver more carbon neutral LNG to them. So, for example, we see more and more companies in the tech industry, such as Microsoft. That's because their demand from their customers is that they provide a more sustainable product. So they are also coming to us and saying that they want all of the electricity, all of the power that they consume, they want it to be carbon neutral. And we see both through our power divisions as well as our LNG and gas divisions how we can provide them with a full package of that, whether that's you know, combining with things such as carbon capture and storage and nature-based solutions to make it a carbon neutral product. If I would have been speaking to you about a year ago, I could tell you that also, you know, we had delivered our first carbon neutral LNG to customers in Japan. But if I look in the period of the last few months through also the COVID crisis, we've now, it's not only in Japan where we've been doing that, but also in Korea, Taiwan, and China, as all where we are now selling carbon neutral LNG to our customers. And perhaps, you know, the most important thing to reflect on there is that that's not just something that we add to the product, but because the customers would like it. No, the customers are willing to pay for it. They pay a premium for the product for it to be carbon neutral. And actually, the feedback that we get from our customers that buy the LNG is that actually the premium that they get in their market from their customers far outweighs the premium that they have to pay to us to source carbon neutral gas. So the next one I wanted to talk about is a couple of areas around C. So what else do we need to do? What have we perhaps had to do in the last months as the prices have dropped? reset our cost base in many areas. You know, how to be more efficient, whether it's in our supply chain, whether it's in our upstream costs, or overall in our distribution chains. And there's another area where I think we have to take the opportunity out of the crisis to hold on to those gains, because I think in order for gas to continue to be successful into the future, not only does it have to be competitive on carbon, but it also has to be compatible in terms of its affordability for our customers. So how do we continue to do that in the long term? One of the things is in terms of how do we actually design and build our sites. So there are projects at the end of the day. So how do we get our scoping right, starting from design and specification? So let me just maybe go to a specific example, which is one of our projects in the northwest of Australia. So this is a new project that we're working on, the Crux project, where we've designed a field, the offshore gas field, which will be completely remotely operated. And so because of that, and because of, as you can imagine, the completely different requirements that you then have offshore, you know, we have a significantly reduced complexity compared to more standard processing facilities that would be manned. And this is not near to shore. This is very, very far out, and still we believe that we can do this very well in a remote manner. Just to give you a sense of scale, that's allowed us to reduce the capital costs of that offshore development by 60%, 60, as a result of that. Maybe a different example is more on the downstream side. So this is on our this is our LNG retail sites, you could say. So where do we deliver actual to transport customers? So this is and in terms of our refueling sites, of developing new solutions in terms of boil-off gas and pressure at various stages. So, you know, based on the redesign of that, we can drastically reduce the plot size of these refueling sites, and ultimately also reduce the cost by 50%. These are the kind of savings that we're seeing in different areas. They're not in the 5 or 10%, but in the tens of percents, and the kind of things we need to deliver for our industry to remain competitive into future. The last one I'll talk about, maybe in the vitamin C area, is collaboration, and this is an area where I'll maybe talk specifically an example around Sakhalin, so closer to home to the business here in Russia. And I find that still too often, and to be honest, I could be talking about the U.S. Gulf Coast, I could be talking about the east coast of Australia, or in Sakhalin. And I think we still too often as an industry work individually as separate companies and separate operators, and don't seize the opportunities of better and stronger collaboration. This, of course, can be in the more obvious areas of sharing operational services and costs. You know, building together the kind of local supply chain and industry that will lead to lower costs. But also in terms of actually working together in terms of how do we actually develop the infrastructure in the region? How do we pool different resources in terms of gas resources into the most optimal developments? That wherever I've been around the world, and John referred to a few, I still see us do too little of this in terms of we still too often compete rather than collaborate together, in order to make sure in the larger energy transition, perhaps we need to sometimes reflect as a gas industry, where is that competition out there, and how do we collaborate in order to give the outcomes that our customers need. The last one is maybe near to my heart as a C, is just the care. And if there's one thing that I've seen in the last months and during the COVID crisis, is the enormous care that I've seen from people inside the company, outside, from our partners and around us. I could truly say that whilst perhaps the COVID itself is one of the worst crises that our globe has seen for some time, at the same time I believe it's brought out the best in people in terms of how people take care of look after each other, care for each other, and companies doing that. Again, something that I think, as we think about our people being the most important thing in our companies, something that I think perhaps as an industry we haven't always done to the degree that you see it today, and something to hold on going forward. So with that, I'll maybe leave it there. Just wanted to share some reflections about what we've learned during this crisis. What are some of the things that we've had to do by necessity? But I think if we hold on to them, how we can make our industry stronger and actually, have turned this crisis into an opportunity in terms of coming out stronger. So just remember the three vitamins: D for digitalization, E for environmental sustainability, and the C for cost, collaboration, and care. John, that's what I wanted to share with the group, and I'll leave it there. Back over to you.
I'm very impressed with the quality of your slides. I enjoyed the pictures as well as the message. So thank you very much, Cedric. Our next speaker is Sandy Esselmont. I've known Sandy for a lot longer than I care to admit. A graduate of Heriot-Watt University, which is a university I've hired more than a few people from over the years. So an outstanding start. First met Sandy when he was CEO at Rockstar. And he's gone on to be CEO of Parker Drilling, where I served as on the board of directors for almost a decade. Sandy's an outstanding leader in our industry and has a tremendous digital background.
Well, thank you, John. I appreciate the introduction. Good morning, everyone. I'd like to thank the USRCC for this opportunity to participate in this dialogue. I very much look forward to a robust discussion. Next slide, please. So Parker Drilling has a rich Russian history. I represent the only oilfield service company on this panel, and I think that's important, particularly when we talked about collaboration. I have that word in my last slide as well, in terms of collaboration being vertically up and down as opposed to horizontal. So we started in Russia in 1991. We've been engaged in Russia for the last 30 years. And in Sakhalin, we've actually drilled 9 of the 10 longest wells in the world. So we have a very rich history there that comes through managing our operations in a particular way. We like to think that we align ourselves with our customers, and we partner wherever we can. Because of our rich history in Russia, some 20–25% of our employees at any given moment in time are working in Russia. Obviously, that has taken a significant downturn since the second quarter of this year. It still represents 20–25% of our employees, but a lot less than we had in the first quarter. And 90% of our employees that work in Russian are actually Russian nationals. So that's very, very important. We believe we understand what it takes to work in Russia, and look forward to many years of cooperation in the future. It's good to see the presentations from Shell and Novatek that they believe there's a fairly bright future in Russia. Next slide, please. So what is the future? I mean, clearly there's an energy transition going on, and clearly there's an energy mix to deal with as we go forward in the next 30 years or so. 84% of the world's energy comes from fossil fuels today, and this is clearly going to reduce over time. The low carbon energy sources are going to make up an increasingly larger share of the energy mix going forward. So I've got some milestones there on the left. Global energy consumption will increase relentlessly. I think we all understand that the hunger for energy will continue. But as we see transportation change and peak passenger vehicles 2024, peak road freight 2029, these are numbers from Rystad. They're forecasting peak oil demand in 2028. And then what about peak jet fuel? I mean, there's clearly some peaks that we're going to see between now and 2030, right? According to companies like BP, we've already seen peak oil. Jet fuel, they're talking about not getting back to 2019 levels until 2025. So we clearly have a challenge in the oil and gas business. But what I've seen in the last 6 months is a massive acceleration towards the acceptance that we have to do better, we have to lower our carbon footprint, and we have to participate in this transition. Gas is going to continue to be a massive component of the energy mix, but there will be solar, there will be wind, there will be hydro, and there's probably some other things in there that we don't yet know about. But gas production will clearly stay as an important part of the energy mix, and oil production is set to decline over the next 30 years. And of course, we look at these charts and graphs, and we can often omit to include politics, economics, geopolitical events, all these kind of things that like we've seen with this pandemic, that changed the curves somewhat. But future oil prices are going to be in the hands of 3 major producers, the US, Russia, and Saudi Arabia. And the question is, what are they going to do to maintain the supply-demand balance? They produce some 36 to 40% of oil, of all the oil production today. Next slide, please. So the energy transition is inevitable. And no one in their right mind right now is believing that by 2050, things are not going to change, could change significantly. The Paris Climate Agreement is becoming the landmark accord. It's pretty much the baseline. Potentially with a new administration in the US will sign back up to the Paris Climate Agreement, which effectively gets the world all on the same page. Russia's energy ministry has urged oil and gas companies to use the current situation as an opportunity to diversify into the renewable energy sector. And it's really encouraging to see Novatek being such a standard bearer out there for lower carbon footprint and sustainability. But it's going to be a tug of war between consumers and governments. The new US government particularly will likely support the need to address climate change and view it as an existential threat. Even the API here in the United States views climate change as an existential threat. The question is, how do we move forward? How do we move forward together? Russia has a strategic energy strategy of decarbonization, decentralization, digitalization by 2035. The US is toying with a Green New Deal, which talks about net zero greenhouse gas emissions in 10 years. The government is net zero greenhouse gas emissions in 30 years with the Paris Climate Accord. So it's going to be somewhere in between. The question is when, and the question is timing. But clearly transitioning to gas is helping to reduce emissions. And it's interesting to see the focus in this dialogue on gas. Reforming hydrogen from natural gas for clean energy fuel cells is a technology that's going to gather pace. So using gas as a feedstock for hydrogen is a possibility. We do need to look at the geothermal sector. I saw a presentation the other day there which said the geothermal sector is set to take off. That is something that is a very near step out for us in the oilfield service industry. We understand the subsurface. We understand how to drill and construct wellbores. and leveraging the technology and the engineering and the science and the know-how and the infrastructure of the current oil and gas and energy companies is going to be extremely important going forward in this transition. If we look at geopolitical challenges, they're always there, right? Governments around the world will increase investment and capital spending of projects that support alternative forms of clean energy. That's what the consumer wants. That's what the Paris Climate Accord talks about. And between the US and Russia, we clearly have some issues, some differences, some political sanctions, if you like, which make it harder, make it more difficult in terms of the technology transfer of unconventional well technology. American companies can't get involved in offshore drilling deeper than 500 feet. And we can't operate above the Arctic Circle as a drilling contractor, as a US drilling contractor. So some kind of normalization of US-Russia relationship would clearly help that technology transfer. But it's clear that we all need to participate in whatever set of facts we're reading from. We all need to participate in this next 30-year energy transition. And when I say all, I'm effectively talking about the oilfield service companies in partnership and collaboration with the oil and gas companies. Next slide, please. So let's talk about the oilfield service sector today. Everybody in our industry is having challenges. So if you look at today's challenges, it's effectively in our industry, in the oilfield service sector, it's survival of the fittest. Health and safety is an absolute prerequisite in this area of COVID. Delivering operational excellence is a given, and minimizing risk, and obviously dealing with compliance. Capital discipline is something that's been forced upon the industry, which is a good thing. But clearly we need consolidation in the oilfield service industry in order to survive. The COVID impact has been devastating for the oilfield service industry. But it's done an incredible job, in all honesty, in working through this COVID pandemic. And I know at Parker, we haven't had 1 hour of non-productive time related to COVID in the last 8 months, which is quite outstanding considering the situation. So maintain operational execution despite minimal access to capital. That's our world these days. No one wants to invest in the oilfield service sector, so it's a bit of a challenge. If I look at tomorrow's challenge, I could argue that technology laggards won't survive. So irrespective of where you are in the chain, there is a need to adopt technology. There's a need to do more with less. We have to have multi-skilled crews. We have to diversify. We need to automate where possible. We need to use robotics when that makes sense, and we need to drive productivity. And I'm talking about productivity from an oilfield services sector perspective. So these are all huge challenges for service companies these days. And on top of that, we need to harness the value of data. If you do not acquire data and you do not use data today, and I'm talking about harnessing big data to drive your automation and your connectivity, again, you will not survive. It was lovely to see Cedric's presentation where he showed his ability to walk around a plant as an avatar. I mean, that for me is just outstanding. Clearly, a bunch of investment needs to happen in that particular area. The challenge for the oilfield service industry is lack of capital to do that. So that's where consolidation comes into play. And I would say support to a certain extent from the operators that are requiring the continual service excellence that they want from their oilfield service companies. We also have an everyday challenge, which has been mentioned in a couple of slides. ESG, environmental, social, and governance, is a prerequisite now to navigate the transition. And in fact, there's almost a battle to see who can be top of the league, if you like, on ESG. This requires companies like Parker, which we're doing, to be introspective, looking at what we do, everything we do, looking back at what we do, to see setting 2019 as a baseline, and then looking at ways to reduce our carbon footprint. So not participating in ESG and making the necessary investments, you will not survive in this transition. Next slide, please. So the thrust of my presentation is really about collaboration in this era of mutual dependency. So we have got I think in the energy sector, although we have a continual increase in the demand for energy, I think the oil and gas business has lost the hearts and minds of many. Our messaging needs to improve. Our ability to work together needs to be better. Oil companies that have the capital and the will to invest in long-term projects need to look at their supply chain and include the service sector in a long-term sustainable way. Too often as an industry, we hire, we fire, we have a short-term view on life. And that's something I think that we as leaders in this industry need to talk about and probably need to get better at. We have to participate in the transition to the extent whereby we don't need to be laggards in climate change. We need to participate. We need to help drive a lower carbon footprint. We need, as an oilfield service sector, we need long-term contracts. We need long-term investment. I've heard a couple of presentations today which talk about the need to maintain cost, the need to reduce and manage cost. The only way an oilfield service company can reduce and manage cost is if he has visibility in his revenue stream. And that is something that, over the last 8 months has been somewhat of a challenge. In talking about challenges, the Russian Energy Ministry anticipates overall investment in national drilling activity could decline by up to 40% this year. We've seen a 50% reduction in drilling activity internationally. We've seen a 75% reduction in drilling activity in the US. What happens there is the rigs get laid down, people get laid down, equipment gets laid down, and to start back up is clearly a challenge, right? So rather, we have to somehow manage these massive peaks and troughs in our business and clarify our messaging out there so that we are actually seen as a viable participant in this energy transition. I can't overestimate the need for technology and collaboration, but I often end these kinds of presentations with more questions than answers. It was mentioned early on, I think this is something we might talk about, is what set of facts are you working from? It is very, very difficult in an oilfield service company to figure out who's right, who's wrong, what the next 3 to 6 months will look like, let alone the next 3 years. So next slide, please. So I'd just like to end my presentation with some key questions that I would like either answered or at least discussed, which is, what will be the growth rate of alternative energy sources? I mean, we all see graphs, we all see charts, we all see projections. It's an incredibly complex crystal ball that we're looking at, but the growth rate of alternative energy sources is something which is clearly important to our industry. How do we bring investors back into upstream, into OFS? That's going to require messaging. That's going to require a significant heavy lift in terms of making our industry attractive again. And I can see in an accelerating manner that everyone in the energy space, and that's energy companies, including oilfield service companies, are trying their very best right now to do that. But as an industry, we need to do better. And then who are going to be the winners in the energy transition? If you talk to Microsoft, it's definitely not going to be the oil and gas companies. I believe it will be the oil and gas companies if they transition to being energy companies as they are, and have a long-term view on this particular transition rather than quarter by quarter. And then, what will the geopolitical situation between the likes of Russia and the US be when it comes to technology transfer? Because we're two great nations that could actually help one another out in a much more productive way. If we could just get the politicians out of the way, it would be a lot easier, but that's clearly not something that is possible. But there is technology in both sides of the fence that could benefit. Back to this collaboration question. And then really government policy, the US and Russia, and the US with Russia. So these are questions that I continually ask myself. So that brings me to the end of my presentation. Thank you, Mr. Moderator. Back to you.
Thanks, Sandy. Well, we have one more speaker, and then we begin the Inquisition, where people can jump in and ask questions. And I have a few, hopefully thoughtful, but otherwise time-filling nonetheless. Our last speaker is Dr. Sagers. I'm really glad to have him here, really an expert in Eurasian transportation products as well as infrastructure, and pretty excited to have him contribute today as well. And so we're going to turn it over to you, Dr. Sagers, and let you bring our presentations to an end.
Thank you very much, John. I also want to thank the RCC and the other panelists for their participation and the opportunity to speak here. I think that we've had the opportunity to listen to very sobering, but at the same time, generally very optimistic views of our future. And I think that I share that general perspective too. And I want to talk about the role of Russia and OPEC Plus, and both short-term and long-term. Next slide. The key thing that happened with this latest OPEC Plus deal is really kind of almost groundbreaking. And again, you can basically see what an iconoclast President Donald J. Trump was. He basically overturned decades of US international oil policy by helping to broker a deal between cartels. That's almost impossible to think of. But basically they put them back together again after the very fractious trial separation that developed in March to put a deal back together in April. Well, what does this mean for the oil market? I think first off, one of the questions for us is, has the US now really crossed the Rubicon? Is it now going to be directly engaged in global oil market management? Or was that really kind of a one-off event? That's something that we'll have to wait and see. But I think for us, the biggest thing that happened was Russia is now pushed into a much more central role, basically front and center in terms of market oil management, rather than remaining a more peripheral player like it was before in the OPEC Plus arrangement. And by hook or by crook, Saudi Arabia has basically got what it's wanted, which is the other 10 million barrel a day producer together squarely in its corner. Now, what the deal does not change is it really doesn't provide a remedy for the coronavirus disease or conjure up oil demand growth. In fact, what we're going to be looking at is the real problem here is basically the pandemic and very weak oil demand. And what this has done is this puts enormous pressure on the participants in OPEC Plus to achieve very high compliance, to achieve any kind of support for global oil markets. Next slide. We're in the middle of the largest economic contraction since the 1930s. Global economy is going to shrink. We're going to lose the equivalent of Germany, Spain, and Austria. And that's just simply part and parcel of what we're dealing with. Next slide. And as a result of that challenge, OPEC Plus put together this new arrangement. They basically, the other thing is that it extends over a longer period of time. It's very adjustable with a series of ratchets that exist. For Russia, it's basically 500,000 barrels a day with each periodic ratchet. But the other thing is that we've already seen so far in June was they basically changed the nature. They're looking at the oil market, and we're going to see that again going forward, where it's going to be fairly flexible, and they're going to adjust to situations on the fly. But nonetheless, it's almost unprecedented to have the kind of compliance that we've seen since June. Next slide. And the story here is that after disagreeing on tactics with the first round of the pandemic, when it just affected China, and we had kind of this trial separation. A lot of people call it divorce. I basically disagreed. I thought that the overall pressures in the oil market would drive them back together again, and that is exactly what happened. It just took a little marriage broker named Donald J. Trump and the Secretary of Energy to put Humpty Dumpty back together again. But they agreed upon just some absolutely massive, massive cuts to basically do this. And a lot of people asked me the question. They said, well, you know, why did Russia balk for only 300,000 barrels a day in March, and then they agreed to 2 million barrels a day a month later? And the answer was very simple. There was just simply nowhere the demand to go. The evaporation of oil demand was just simply front and center. Next slide. And this basically looks at compliance overall. And Russia did okay. It was 90% in 2017 and 2018, which is kind of good by OPEC standards. It dropped a little bit in 2019. But in the first quarter of 2020, with condensate excluded from Russia's total liquids target for the first time, compliance was basically 100%. And that condensate exclusion ends up being quite critical overall. Russia produces 800, 900,000 barrels a day of condensate. And what it does, I mean, we heard from Mark first, but basically what it means is that Mark can basically pursue his LNG agenda without any concern for condensate production. He can basically respond to what he sees in the gas market, the LNG market, because that Yamal LNG project that Mark talked about, it produces 1.5 million tons of condensate per year. And just imagine the challenge that Mark would have if he had to basically think about maintaining some kind of a quota to do that while he's pursuing his gas agenda. So this ends up being quite critical for Russia and for the other FSU countries as well. Next slide. And here we see a couple of slides that basically show why the CIS members, in particular Russia, have a very strong incentive to basically remain within OPEC plus. Now, Russia budget does balance at a much lower level than does Saudi Arabia. But I want to point to the slide on the right. If you look at 2016, which was before they joined OPEC plus, and then look at 2019, if you look at that green checkered slide in the green checkered number, it's $100 billion higher in 2019 than it was in 2016. But if you look at the green solids, you can see, well, the amount of oil that was produced and exported really didn't change that much. That's totally a change in price, and that's OPEC plus. I think $100 billion, you can see why that kind of focuses the mind and changes views about being part of this deal overall. So that's basically what drives this is basically the role of revenues in national budgets overall. Next slide. And currently, this is kind of the challenge we're at right now. We saw that demand recovered from the depths that we saw back in April and May. it sort of sprung back. We had a little bit of a V. If you remember, there's been all these discussions, W, Vs, Ks, what is it and everything. But basically it showed that V. But then what happened is as we basically came out of that initial V, we're now stuck in a demand plateau after some recovering. And it looks like we're going to see very little additional demand increase until COVID is contained and effective vaccines are available. People are still basically working from home, not driving into the office, not going on vacations. And so demand just sort of seems to be stuck there for the time being. And this creates a certain degree of pressures and challenges because instead of additional demand, we've had an additional challenge. Next slide. And the challenge is more supply has come out instead of demand. And this is basically something that we have to think about longer term for OPEC Plus. A lot of people have been asking me, well, Russia was looking for an exit strategy. What is the exit strategy? What will allow them to leave? And I think the key factor here is kind of what happens to US production. And, and it comes back to kind of a political question, what happens to fracking overall? Because if the US ends up having base load, but it really can't respond incrementally before, that basically changes the whole calculus. But instead of being down and out, take a look at that green dotted line on there. US came back. It basically begins to show some resiliency. Libya's basically stabilizing. And now we have the prospect of Iran coming back in the market. And what this means is that Saudi Arabia and Russia and the other members of OPEC Plus are just simply going to have to be a lot more patient about what they're going to be doing in terms of their next round of ratchets, which is supposed to happen in Q1 2021. And I wouldn't be surprised if the decision is basically announced very shortly that they're going to postpone that, just like they did in July. But what is very clear is that with this additional supply, kind of demand plateau, Saudi Arabia and Russia and the other members of OPEC are just simply not going to be able to ramp up like we were expecting before. Next slide. And I think that we want to keep that idea in mind as we think about longer term as well. Next slide, please. And of course, what everybody's talking about is, kind of where price is going to go, what it is. And basically with this plateau in demand, our key scenario, our base scenario is that prices are going to remain soft and remain less than $50. But the key part of all of our three scenarios here is what happens to COVID, the lockdowns, and kind of the policy response for this. It barely clearly has to do with, is COVID contained? We can have a much more rapid response. If it isn't, we could have a much more weaker demand, and with the corresponding price scenarios that go along with that. But what you're basically seeing, I think, is something that is going to continue to be a challenge longer term as we move, which is supply seems to be much more abundant and much more easily swung than demand is in this transitionary world that all of our other speakers have been talking about. And that probably means that basically OPEC Plus is probably going to have a role for a lot longer period of time that a lot of people are going to be comfortable with. Next slide. And this is a slide that basically looks at, okay, what happened before? And when we look at the demand shock in 2008 and 2009, it reset at a lower level and then returned to its trajectory. And next slide. This is what we think is going to happen now. We're expecting this pattern to be repeated. We will basically have a reset and then a return to the trajectory. Now it's going to be a little bit different. We're going to be looking at more work from home. We're going to be looking at a whole lot less travel and so forth. But the key thing I want to point out here is implicitly this scenario basically sees COVID as a one-time black swan event. That is different from a lot of the other scenarios. This is not the only scenario that is possible. Next slide. And that basically looks at longer term. Our base case is that rivalry scenario across the top, where basically our demand projection is reset, but it basically resumes the previous trajectory. And so we're looking at peak oil demand sometime in the late 2030s, from all of the combination processes that we're talking about. More efficient vehicles, shift to electric vehicles, more work from home, mobility as a service, all those sort of things. But that is not the only scenario. Another scenario that has become very popular at the moment to talk about is that basically 2019 was peak demand and we just didn't realize it. And there's a number of features that go into that, but clearly we've got a fairly wide range here to sort of think about in terms of the longer term future. But nonetheless, I think regardless of the picture we're looking at, it's going to be a situation where demand is going to end up being under a lot of pressure and very challenged, even though we're looking at a fairly weak price scenario overall. And that means there's going to be a lot more pressure upon suppliers, and that includes Russia as well. Next slide. This is basically looking at how the Russian authorities have basically swung this. Last March, as we were talking about this, a lot of commentating was coming out of Russia that basically said, this is impossible. Russia cannot possibly swing production the way that Saudi Arabia does. Saudi Arabia can swing production by 2 million barrels a day, no sweat. Russia can't do that. The climate is different, the whole number of fields, the structure of production, et cetera, et cetera. And the answer is, yes, they can. They've got a lot more flexibility than I think that people give them credit for. And I think that they can basically swing it up, and I think that they can swing it down as well. But a key factor here is basically well deactivations and so forth. As we look at the longer term future, I think that it also looks fairly bright as well. I think the concerns about long-term reservoir damage are overblown as well. The one thing that is different this time around, that is different from before, is the Russian government was very concerned about something that Sandy is, which is the oil field services thing, and they wanted to make sure that basically their activities didn't collapse overnight, that they didn't experience that 40% decline in spending and activity. And so the result is they've tried to implement a drilled but uncompleted wells, a DUCs program, to try and basically soften that blow a little bit. And it's been fairly controversial. A lot of the companies have not really been keen about it, but that's basically different. And you can see that Russia is thinking about its long-term future and how to maintain a viable oil field services industry. Next slide, which is my last one. Again, I think that this is something that Sandy has pointed to before. When we look at the key upstream indicators, they are downward, as you would expect. They are downwards this year, but not nearly by the same kind of amount that you would have expected. And again, I think that this fits within the previous pattern. What we've seen in the previous time before, when we had the previous cuts, Russian companies tended to maintain activity. They spent a lot more money, they drilled wells, they completed wells and so forth. And what happened was they built up spare capacity that could be brought back later. And I think that they're doing the same thing in 2020. So the one number that I wanted to draw your eyes to was that development drilling, January, September, fell by only 2%. That's nothing like what they were talking about earlier on. And so although we have these key investment indicators declining, basically it looks to be in the same range what we saw in the same period. So it looks like Russia is doing the same thing. They're basically continuing to maintain their level of activities as best that they can. They're basically sort of building up spare capacity. And the plan is, of course, that when the gloves come off at the end of first quarter 2022, that they'll be able to basically put this spare capacity back in and basically take production back up to 11.5 million barrels a day. And I think that the key question for us is there going to be demand for that globally in the world? Russia is a very low-cost producer. It's, let's say not in the same order of magnitude as the Gulf producers of OPEC, but it is still a very low-cost producer, and this basically gives them an enormous advantage going forward. The other thing is that Russia has a big oil services industry that basically covers the bulk of upstream procurements. And so the result is that basically we've seen costs also decline dramatically during these periods of times when oil prices decline because of the ruble devaluation dividend. Essentially, The ruble is a petrocurrency. It basically goes up and down with oil prices. When it goes down, essentially costs do too, because the companies are getting their revenues basically in dollars, and they pay their costs basically in rubles. And this basically gives them a tremendous amount of flexibility going forward. So overall, I'm very positive and optimistic about the Russian oil industry going forward. We see a lot of challenges like everything else. And I didn't even mention the word sanctions at all. I managed to sort of get by with that. I basically talked about the one area where US and Russia and Saudi Arabia actually collaborated this past year, which is pretty unusual, to basically do something that I think was quite good overall for the company and for countries involved. But at the same time, you can see the challenges emerging here to sort of do this going forward. And so I think that despite the fact that Russia wants to talk about an exit strategy, I think it's going to be very difficult to do this as we look over the next, let's say intermediate period of time. And probably we're going to see something that's going to come into effect very much like that in 2022, unless there is something dramatically different on the supply side. We've heard a series of comments that basically with this latest price plunge that we've had, a lot of places around the world have cut back CapEx, cut back production, and we could have a shortage of supply emerging, after 2022. But given what I see happening, I don't see that as a very likely scenario. We're probably going to end up with a situation where demand's probably going to be challenged and there's going to be ample supply that's going to keep this in there. But again, it's going to be up to OPEC Plus to try and manage the market so that oil prices can remain on some kind of an even keel. Let me stop there. I think I raised a lot of questions like Sandy did about the future of this. And let's go on to some discussion, John. Thank you.
Got myself unmuted. Developing skills in a webinar era is a real challenge for people with beards this color. But I'm going to start out with probably, and I think we can sort of get out of the slide mode there. That's great. I'm going to start out with a question that sort of crosses everybody and say that in any industry at any time, human capital is probably the most precious item. And we find ourselves now where real estate is not considered to be the anchor of companies anymore. We've moved into sort of virtual workforces. And how does that change the competition for talent globally? And how is our industry going to continue to attract A-plus talent into the sector when we have been stigmatized by a number of other industries and government as well? And so what is our thoughts around virtual workforce and the changes that are occurring right now on the social side of our industry? Mark?
Well, I think, John, you hit a couple good points on just your question, because I think the biggest concern that we have today in terms of hiring is the perception people have on the oil and gas industry. I mean, it's no longer considered a sexy business to go in. The age group that we're dealing with at the university levels are reluctant to enter any oil and gas because they're looking at this green movement and think that renewables might be a better place for them to have a future career. So I think you're really going to rely, outside of the core oil and gas type universities in the United States that traditionally brings out professionals. I think you're going to rely on countries like Russia, who does have a buoyant oil and gas industry, who does have a buoyant educational system, professional development system, for engineers, geologists, technical people. China will be another one. And I think you'll see more and more individuals coming out of India. So I think you'll see a more diverse group of people that enter the work world. But I think here in the United States, it's going to be challenging because of the perception people have in terms of where tech is more sexy, oil and gas is passe.
Yeah.
John, just let me comment on that very interesting data point. I was talking to my 16-year-old son the other day there, who is, a typical 16-year-old boy. And I was trying to tell him and show him the type of messaging that the oil and gas business is going out with. And it was on YouTube, and it was basically everything we were talking today, that oil and gas can be a participant and a valued part of the mix, and that it's kept the lights on, it will continue to keep the lights on. And it was a very kind of friendly YouTube video based on trying to educate people on the value of this business, right? Within the context of an environmental climate change impact and a transition. And so I showed him that YouTube video, and he said, yeah, okay, no, that's pretty good. How come I'd never see that? And I said, well, it's out there, right? It's out there. And he said, let me show you this. And he showed me a YouTube, which was an argument driven by the kind of the anti-oil and gas lobby. And he said, look at the number of hits in your video and look at the number of hits in my video. And in our video, we had 1,475 hits. In other words, there was 1,475 people watched that video. His video, 2.7 million people watched his video. And he said, he simply said, Dad, you have a messaging problem. Whatever you think and whatever you guys are doing, it's not getting out there. It's not getting certainly to the young people. So I agree with Mark. I think we've got a messaging problem.
I couldn't agree more. But let me basically amplify a few comments that Mark gave. I find that the younger generation are quite prepared, and they're very excited. And so I think that the most important thing for them is the quality of the work, the excitement, the challenge of the work. If they find the work to be challenging and exciting, believe me, you're gonna bring them in. But at the same time, there is going to be a much greater diversification, greater diversity, and geographically, as well as, you know, age, sex, and ethnicity, and all those sorts of things that goes along with it. And I also think another very important part is flexibility as well. They don't want to be tied to that office in central London. And so for me, it's basically about the quality of work. If they want to live in Telluride, Colorado, and telecommute, and you get your job done, fine with me. So you know, there's also along with that. Now, is it very realistic for a young 20-year-old to work in Telluride, Colorado? Probably not, but you know, flexibility is the other kind of thing. So I think that being flexible and basically being exciting is a key part of this. And then we also need to recognize that foosball tables and ping pong tables in the workplace and beanbag chairs are not really what they're looking for. It looks cool and everything. That will be gone in 5 minutes. So I think that we still can be very exciting and very engaging as an activity for the younger folks coming in.
And let me maybe build on that, Matthew, the point about flexibility. And I think one of the things we're learning from these months is how to do that better, right? And yeah, and we're already seeing in our company that we've actually taken the opportunity in the last months that we've been not using to the same degree our offices, to remodel them to places whereby, you know, people don't sit behind desks anymore and do work themselves, which we refer to as me work, but more to areas where people collaborate. So it's more of a offices, intending them to become more of a series of meeting rooms and collaboration spaces and other things. So that's we work. And then that people, if they do the type of work that we used to do behind a desk in an office, they simply do that from home, and using these kind of tools we're doing right now. Yeah, and that saves enormously on commutes, flexibility, etc. And I think one of the things that beyond the kind of physical things that requires, that different way of working, I think the other thing that it requires is a different, how shall I say it? It's a different level of trust in terms of how you work with your employees, right? And to no longer be maybe as focused on how many hours somebody's clocking, but the output that they deliver. And I think that's an element that is, you know, it's not just important for the new generation. I think it's for all of us. And those kind of adapting to that way of working we've probably in our industry have not been as good at as some other industries have. And so maybe this experience of 2020 will be a way to kickstart ourselves into a slightly more modern way of working as an industry as well.
John, can I just add just one more question? Going back to what Sandy was saying, because I think he raised a good point on sort of the misconception of the industry. I think people don't understand. They take it for granted when they walk into a room and put on the light. They take it for granted when they put on their computer and all of a sudden it comes on, or they want to charge their phones. And I think, you know, a period of time when they're taken away from all this stuff will change the perception of how people view the importance of the industry. You know, because right now, like I said, too many of these kids are out there and you know, they take everything they do on a day-by-day basis for granted. And just what Cedric was talking about too, I mean, Deutsche Bank is proposing to issue a 5% tax on people who stay home and work remotely. You know, and you see when you have that kind of idea where they're promoting an idea, what Cedric was saying, you know, not only are you giving people a chance to do something more effectively, but you're reducing climate change questions, and now you're penalizing people for doing something like that. So I think we got to get, you know, back to a table where everybody's sitting and talking on the same page, because right now we're on opposite ends of the spectrum, and this is really damaging for both parties, because I don't think, like as Sandy said, the messaging is very wrong right now.
Can I add to one point that Mark just made? And it's just a data point that sometimes people forget in this debate. There's still 1 billion people on this planet that do not have access to energy. Yeah. And so we're always talking. So it's not just about cleaner energy. The world still needs more energy as well, right? And I think it's both of those together. Yeah, exactly as Mark said. If you have reliable energy around you, it's a different debate than if you don't. And 1 billion people. Yeah.
I do want to encourage people to enter their questions under the Q&A piece, so that we can catch some from outside. And then I comment just quickly on that, Mark. I often teach ethics in the industry. I was the lecturer for the AAPG and the SCG and others. And the real challenge is getting people to understand decisions are trade-offs between right versus right, not right versus wrong. And our energy challenges really fall into the short-term, long-term trade-offs that need to be made, where it's both right to produce hydrocarbons and use them, and it's right to transition to sustainable. And then it's a debate that needs to occur. It's not a right-wrong, and we're allowing society to drive everything into a right-wrong arena as opposed to a right-right arena. And I've never made a business decision where I wasn't trading between two rights. If it's right versus wrong, that's not something we deal with in the business world, and it's something that we have a hard time telling our children and the public and others, that we really do struggle in boardrooms around right versus right. I'm going to keep going. We had a good question here. I'm actually on the board of a lithium producer called Orocobre, and we produce lithium from brine, from salt water in the salars of Argentina. And so this question comes up all the time in my board meetings. And how is electric vehicles, the adoption, going to affect the energy sector? And this takes me back to the misconception that somehow batteries in cars charge themselves. And so it would be great if you could sort of walk through the difference for people between storage and primary energy source, so that we can sort of understand the electrical vehicle impact on energy production. And any of you that want to chime in would be great.
I started. I mean, I think when you talk about this concept of G mobility, you know, or EV mobility, you know, because also as we talk about this, we're also talking about moving vehicles to compressed natural gas and or LNG. I mean, we have set up a platform, and I think Cedric briefly talked about the small scale, the retail, multi-fueling stations, et cetera. I mean, EVs will play a huge role in this transition, but I think you'll also see a big change whether you do the shipping industry with bunker and fuel moving to LNG. You'll see the change in more and more light and heavy vehicles move towards compressed natural gas or LNG. And so we're trying to position ourselves as a company, not only in Russia, because in Russia, we just launched in July our first small scale LNG complex in Magnitogorsk. And this has been working from pilot programs we did with the mining sector. So now we're connecting this sort of roadway from Chelyabinsk region all the way up to Northwest Russia in our Cryogas project. And we're building out multi-fueling stations so that we can work with companies that and individuals who want to have that choice of fuels they want to use. And I'm sure some of them will have the electric fueling stations there also. And the other thing now is like working with the Russian railroad. How do you convert something that has traditionally been coal or fuel oil? And we're working on them to move into natural gas. And the same story plays itself out in Europe. I mean, there's such exponential growth in just focusing on not just EV vehicles themselves, but also moving away from petrol type to natural gas. It's a huge growth opportunity that we need to consider.
Let me just add one more thought here. And that's, again, this transition is going to be multivariate, as Mark has indicated. And it's also going to be a lot longer in its terms than what people think. So even if, for example, by pick a year, 2030, 100% of all new vehicle cells could be electric, which they can't be because you can't produce that many vehicles, grow production that fast. But you still have all of the other vehicles that are still in the fleet that account for 99.9% of the fleet. Those vehicles aren't going to go away. So just when you look at just simply the math, it basically tells you that this is going to be a much longer transition that's going to be multivariate in a variety of ways. And the future of gasoline vehicles is not by any chance done. There's enormous potential for reducing their miles per gallon, increasing their efficiency, and so forth that goes along with that as well. Smaller vehicles, more efficient engines and so forth. So it's going to be multivariate. It's going to be much more extended than a lot of people tend to think.
Cedric, you were speaking with the microphone muted.
Yeah, I was a microphone off. Yeah. I maybe to similar comments, but approach from a different direction. If we want to make the energy transition work, right, that the globe has as an ambition, that doesn't, let's take China, for example, wants to be carbon neutral by 2060. I think you need to pull almost every single lever that's out there, right? I mean, just to even get close to the kind of ambitions that we want as a society. And in order to make the most use or the full use of all the kind of low carbon or carbon neutral sources of energy out there, we're going to have to increase the electrification of our industry, of our economy as a whole.
Yeah.
It's just under 20% today of the energy that we consume that's through electricity, right? I mean, a lot of times in the public debate, we think energy is power, right? It's not. 80% still of energy is consumed in ways other than electricity. So that needs to grow. And indeed, some of the areas will be like vehicles. I'm 100% aligned with Mark that we see the space for electric vehicles in the light mobility space and not in the heavy mobility. So not, heavy transport, vessels, trains, etc. And there we see gas as a much more, logical answer to decarbonize. Now, the thing you mentioned, John, is critical because that's the point around the electric vehicle and where is then the electricity generated from, right? And that's a fundamental question even today about where is the balance of what's the end-to-end full life cycle carbon balance of let's say a highly efficient internal combustion engine and an electric vehicle. Which one is more carbon, neutral or lower carbon today depends on how the electricity is generated. Now, if it's renewable energy, let's say from solar or wind, that's obvious. If it's gas, then it also tends to be better. But most countries around the world, if you take the average energy mix of the electricity, grid right now, it's about a toss-up, and if you use coal, then even efficient internal combustion engines can end up having a lower carbon footprint.
These are all sort of good points, and it's the complexity of this. So it gets me to sort of a question I really look forward to the answer to. I know that on social media that false stories are documented to travel 6 times faster than the truth. That's That's one of the facts from social media. And so when we start trying to deal with facts in general, right, which most of us are scientists or mathematicians or economists, we tend to deal in numbers, and we're really robust and rigorous, particularly our CFOs here. And so we have a hypothesis, we work it through. One of the challenges I'm finding today, and I'd be interested from you, is where do you gather facts from, and how do we get to something that's not driven by social media false reporting around, whether it be lithium or wind, et cetera, in terms of the balance of carbon, as opposed to where we have a legitimate discussion as opposed to an emotional discussion. Where do you go for facts, and how are we going to evolve in a web world and an internet world so that we can actually discern facts and make better decisions? How does your company do that? How do you do it personally?
Well, I can say a few words there from experience. It's pretty daunting today to take a view which drives the strategic direction of your company over the next 5 to 10 years. You have to base that on something. And with Google, you can pretty much find anything you want which will justify whatever point you want to take. So it's a real challenge. It's a real challenge politically. Clearly, we've seen that. There is fake facts all over the place, and I guess I don't know. I haven't managed to figure out all the time what's fake and what's not. But I think as long as we aggregate our data from what we believe are credible sources, then we probably will get to some kind of consensus. If we just go online, and I see that again with the youngsters, they believe the written word wherever they're getting the written word from. So it's back to this messaging thing. But I think it's a real problem. I think it's a real problem for society, John. Is that we all try and base decisions on fact, but you can get whatever facts you want, right? Maybe Matthew has the answer here, as he deals in facts.
Well, at least the ones that support his opinion, anyway.
The ones that support his opinion, yeah.
That's true. But I was just simply going to ask Mark. We had a very famous example just very recently about Engie, the French company. They had a U.S. LNG contract, and they basically ended up handing it back because of all the pressure and the information that came out that basically claimed that U.S. LNG is absolutely dirty in terms of its thing. When you count in the carbon footprint, the fracking, and the flaring, that basically that LNG is a very, very dirty commodity. A lot of social media and falsehoods came out about that. Mark, did you have any views or opinions?
Yeah, I was going to first say to John's point when he said the speed of false information is quicker than the truth. And I was going to say, the next move for us is when we get censored by being in the energy industry, by the tech industry, by basically saying what we're talking about. If it's not in line with the green energy deal, will we be able to get our information disseminated properly? But to answer your point, Matt, I think that's a unique deal. I mean, we're not quite sure yet the full ramifications, or is that just posture and position now that the U.S. has left, the Paris climate change and there's certain green agenda in the European Union, that basically we're not happy with President Trump's decision to pull out. But we all know from an industry perspective that there is a sort of negative connotation to development of the APG, associated gas out of the Permian Basin.
Yep.
The amount of flaring that's going on, and quite frankly, I mean that's not even talking about the fracking element of it, but you also do have people that have questioned, and you see this Green Deal, this anti-fracking movement, which you alluded to earlier. There's just this misconception about the the safety of fracking and how many years have we used it as an industry, because I think if fracking comes to the United States, if you get this fracking ban or a curtailment of it, I think you're going to see a dramatic drop in U.S. output, and that benefits countries like Russia and the Middle East, in terms of our output, but in terms of the LNG process, I mean, one of the things that we've been able to capture at sort of Novatech is the distance we move. I mean, our field is right there at the plant, which is right there at the port. So we don't have this long distance of moving natural gas. All the equipment is brand new. We have the ambient temperature differences, et cetera. And I know Cedric kind of talked a little bit about the green. I was going to come back when we have a chance about this sort of green LNG, because that is the movement now. We're starting to see more people looking at green LNG. The only thing that I would differ with Cedric said, he mentioned that people are willing to pay for it. Pavilion just had their big contract, and at the end of the day, when you see who was the winner, it all came down to price. It didn't come down to the green movement, even though we went through all the sort of production of information about the methane leaks and green and the emissions of this gas. At the end of the day, it came down to price. So it's kind of curious when Cedric made that comment that customers are willing to pay. We just don't see that today. But I think the anti-fracking movement and its destruction to the U.S. oil and gas industry would be dramatic. But I think this may be just a temporary decision on the French government to cancel the Engie contract. I mean, I go back and we can talk about the competitive. See, to me, this also goes into the question of competitiveness of LNG, because, the same question can be raised on looking at, Petronet and their decision with Tellurian. They see a volume of natural gas that's being coming into the marketplace in the form of LNG in 3-4 years. And so the question is, why do I need to make that investment? I can buy cargoes, short, mid, and long term. Why do I need to make an investment? So I think you have that competitive question also that comes in play maybe with the Engie contract.
Yeah. So Matthew, I actually understand from Engie, having spoken to them, that they don't subscribe to the way these reports go out at all, and so maybe it is an example of alternative facts indeed. Again, what the bigger picture though here is, and it's tying into what Mark said, what I said earlier, and what you're saying here right now. I do think that going forward, whether the customers are going to ask for it to be completely, carbon neutral and pay for it, or whether people say, I'm just going to pay basic market price, but I'm going to want the lowest carbon footprint I can find for that basic market price, because I think you're going to have different customer segments that are going to be looking for both. I think going forward, you're going to see more and more customers asking their LNG suppliers, and similarly other products, tell me what your carbon footprint is. Yeah. So and I think that's probably the thing to take away from this, and not whatever was quoted as what it was, or if it is dirty or isn't dirty. But there is going to be, I think, differentiation and relative competition on that factor as well going forward, in addition to simply price.
Yeah.
So just to add in some price numbers to that, just to get to your point about the competitiveness. If you look at a 170,000 cubic meter vessel, which is standard that we use at our Arc 7s, to sort of get a sort of green cargo, you're talking about $1.5 million to $2 million per cargo, which is about 50 cents to 80 cents per MMBTU. So what is the price today? If the price is $5 and it's going to cost you 1/10 of that just to green it or more, I mean, there's a question of who's going to pay. And this also goes in that broader question on the EU carbon tax question. Who's ultimately going to pay for this at the end of the day? Is it going to be the consumer? Is it going to be the producer? So I think that this is an area that we need to pay close attention to, and we have to be in the forefront and be proactive rather than be reactive. Because if we're reactive, we're going to get taxes shoved down our throats.
Yeah. I also think it's incumbent upon us to also be proactive in terms of getting the message out, and particularly the facts as well. Mark, one of the interesting arguments that erupted here in the United States was about the carbon footprint of, for example, your product versus US LNG. And there's been a lot of studies done in the US, and they have a number of figures and so forth. And basically, I pulled out your report, and I basically said, you know, here's the story for Novatech. I got so much pushback. They said, oh, that's Russia. We can't trust anything. We don't, and I just got really very frustrated, because I said, look, this ESG report, it has the same implications as the financial report, as the operational report. These guys basically trade in the market. They basically have international shareholders. This is information that has to have a very high degree of collaboration and correctness and so forth. So I said, if you're challenging the ESG report, well, then what does that say about the financials or the operational report? And I said, and these are very credible companies doing this. So again, it comes down to these kind of fact questions, whose facts are the correct ones and so forth. But so like I said, this came up in the past couple of weeks over this very question of your carbon footprint versus US carbon footprint.
In a most unusual outcome, my son actually learned to speak Russian. And so when we want to know about what's going on in Russia, we read Russian media and not US media, because we find that there's just no information really that's coming out that's useful about Russia and the US media. And so we've gotten to where you have to go really search for facts in order to be able to characterize any country or any industry or anything else. I want to jump to another one, though, because I think in this case, I do believe the U.S. may be leading in a trend that's going to occur globally in our industry. And I'd just like to see if you agree or disagree, or if that's the case. But right now, we're undergoing massive consolidation in the U.S. market. We have ConocoPhillips buying Concho. We've got Devon and WPX merging. We've got Pioneer purchasing Parsley. We have EQT that's acquired the Chevron Appalachian assets. And so it looks as though there's a mass movement towards economy of scale and scope, and trying to take cost out, believing that the long-term strip doesn't really support a lot of margins. So we're having to be more efficient in what we do, as opposed to thinking that growth in demand is going to drive our ability to produce profits. Do you think, A, that's true, and B, if that's something that's going to continue globally?
Let me just sort of offer a general comment. This is something that we see in every single downturn, right? Part of it reflects the value of the assets. They become much cheaper, and let's say moves it into the wheelhouse. Everyone that I ever talked to always consider themselves to be the top, the best, and so forth. And so therefore, they want to they think that they're going to survive, and so they see it as a survival strategy to basically do exactly what you're talking about, which is I basically acquire assets, I basically rationalize them, I spread my operational costs over a larger number of assets, reduce, improve my bottom line and so forth. So it's a very understandable strategy, and I think that it just sort of happens with each and every downturn. And I think this one is no different. So I think that we're going to see it internationally as well. Maybe not on the same scale that we saw before because of the other underlying issues that we talked about with oil and gas, but I think it's just something part and parcel of the overall business cycle that we see in our industry. You guys have seen a lot more than I have over the years, so I'm sure you've got your views too.
Let me say a few things on that. I think it's a particularly American thing. It does happen elsewhere, but it's very kind of exacerbated in the US. And I'm talking from an oilfield service perspective.
Yeah.
I mean, we watch our operators or our customers combine forces and whatever. Generally, there is some kind of negative impact on the oilfield services as they rationalize and always look to take out costs and whatever. At Parker, the good thing is so far, all these mergers, it's been our best customer swallowing our next best customer, which is a good thing. So we see some upside in some of the swath of recent mergers, but the oilfield services space itself is terrible at consolidation, right? I mean, there are hundreds and hundreds of suppliers in the United States, a phone call away from every operator, and he has 5 choices for everything, right? And some of these companies are tiny, they're barely survivable, but because of relationships, a particular relationship, they can survive. In this downturn, people are looking at restructuring. People are looking at all kinds of ways of maintaining the status quo in the oil field service industry. We clearly need to consolidate. We're way behind the operators in this, but we clearly need to consolidate in the oil field service sector in the U.S.
Well, let me expand the question a little, Sandy, before Mark answers. Given that, we say it happens during a downturn, and there are many people that think that we're into a perpetual downturn, in order to have the services that are necessary, do you believe that we will actually see the producers begin to consolidate local oil field service suppliers in order to have a vertically integrated ability to produce and deliver BTUs to the marketplace?
You mean oil and gas companies acquiring service companies to be vertically integrated?
Back to the past, which if you go back to the past, ExxonMobil, even Pioneer recently, BP. When I was at Gulf, we owned a seismic acquisition vessel for offshore. But are we beginning to go into a place where to securitize the services that are required to produce? Will we actually see producers begin to acquire oil field services because of the risk they're under in attracting capital, the fact that they have no revenue during downturns, they have to just sit and absorb all of the cost of equipment because they don't have production to offset that, which is the reason Sandy mentions long-term contracts. Do we think that the next wave could be certain producers in local basins picking up the service companies they need to securitize their ability to produce? And I'll leave it there.
Well, I think it's possible. I think if history is any reference point, it's never really worked in the past, simply because it's not what the customers do. It's not core business for them. I think it'd be far better for them to encourage a sustainable and competitive oil field service supply chain in that particular area. But at the end of the day, I think what you're talking about is possible. There are some operators out there that do that today. We have some Gulf Coast operators that decided to buy their own rigs, staff their own rigs, crew their own rigs, and in this downturn, they've realized what it's like to live in the drilling contracting business, which is something all by itself. So now they're looking at offloading those rigs, getting someone else to manage those rigs that actually knows how to do that so they can focus on production and doing what they do. I don't think the answer is one buying the other. I think it's more of this collaboration, partnership, long-term arrangements, long-term agreements. That would be my, I may be biased in this particular one. So I'll throw it open to the rest of the team.
Yeah, Mark, Matt?
Yeah, John, to answer your question as you first raised it, I mean, you got to go back and look at it. For the past decade, the U.S. oil and gas industry, from an E&P perspective, not integrated companies, the E&P companies, have basically been negative free cash flow for more than a decade. Right? That has put enormous strain on their ability to raise capital when you started seeing a shift away and banks and investors started asking for returns. Look at 2020, look at the amount of impairment write-downs that we've already seen this year in the first half of the year due to the change in the price of oil. So we're seeing a massive destruction that's happened for more than a decade. So I always categorize the US shale revolution as being enormously successful operationally, but financially a disaster. You know, and this has put many companies in the position because it was raised by debt. And when the banks start calling about debt, we saw a massive amount of, you know, not only bankruptcies, but also credit defaults. So it's just an extension of this. A little bit about your other question, and Sandy was what he was talking about. You know, actually, what we built at Novatech, for people, your audience might be interested, we actually did a little bit of what you're talking to, that little question, because we built now, and we're not finished with it, but we are building, is the Murmansk LNG Construction Center inside of Russia. This is really the only construction center in the world, I think, that's fully dedicated for LNG projects. And we will build our future platform all consolidated, you know, in this particular facility where we build not only the GBS, the gravity-based structures, but also we start building the topside modules, et cetera, where all the contractors actually come work with us in the partnership arrangement at this facility inside of Murmansk. And lastly, Matt, your comment on the reliability, read the fine print, you should tell your people, because you'll see that many of the references are not directly out of Novatech. They're independent companies that have actually sourced out these references, and all we're doing is just copying them. So, you know, there goes fake news.
Well, we're Cedric, go ahead.
Yeah, no, I was going to take up Sandy's specific question. I think in the past, the vertical integration, we've seen it sometimes happen because you know, certainly some contractors can be quite critical to particular projects or particular operations. And then if a contractor or service provider is at risk of going bankrupt, there's sometimes that element of bailing them out at those times in order to make sure that you have that continuity. Typically, when you get through that, then you then say, indeed, exactly as Sandy said, okay, how do you offload that again? Because I agree with Sandy. If I would look at our company today, you know, we like to do what we're good at, but we like to work with partners and service providers that do what they're good at. And we know that a lot of those things, they're better at them than we are. So I don't see the logic, you know, unless it's in specific cases that have a very specific value driver of looking for that the vertical integration. Because actually, you know, to be frank, you turn in a lot of instances, you'll turn a good supplier into a bad internal business because you just don't know how to run it. Yeah.
Well, when I was CEO at Halliburton, I'll use an example of Peru. I had a fairly substantial amount of capital in Peru to support the industry in Peru. I was not able to recover the cost of capital in Peru. So I made a decision to withdraw the equipment from Peru. That was detrimental to the people that were trying to produce in Peru. And so then we got into negotiations, which Sandy's talking about. I'm going, well, you're going to have to award contracts to me in other locations for me to be incentivized to take the loss on the return on capital in Peru. And so how are we going to get to a reasonable return on capital by having other operations with you in Angola or Nigeria or another location? And so when you're global, you can do that. But when you're a small provider, it really makes it quite difficult. I think we've got time for one more sort of area just for fun before we wrap up, turn it back to Andrew. And there's a couple of questions that have come in on what does digitalization of the oil industry mean, and how does that work between suppliers and oil companies, and how much transparency and integration and ESG type reporting are going to emerge as a result of digitalization. And so if each of you could sort of comment on that and make a closing remark, I think we'll pretty much be to the point where I can turn it back to Andrew.
Can I start then, I guess?
That'd be great.
Okay. Well, when we talk about digitalization, let's just talk about the recent questions that have been raised about operating in the Arctic zone in permafrost. And so what we've done, which is unique, because obviously we've seen the spill that happened at Norilsk Nickel that was attributed originally to maybe the melting of the permafrost, and subsequently the study that just came out that it was actually equipment fault. But at Novatech in our Yamal LNG project, you know, for those people who don't follow Russia as closely, everything's built on pilings. So we actually drill 38,000 pilings, and all the equipment is above. Each of those pilings has a heat exchanger in there. The heat exchangers are connected to a system that monitors it through the digitization process in our technology center in Tumen, where they can actually look at real-time movement in permafrost. And at that particular point, that is also still monitored by individuals at Yamal LNG, and you can make adjustments to this heat exchanger to ensure that you're not disrupting the permafrost in that particular zone. And that's one example of digitization I'd like to throw out.
Yeah, let me build on that. So I think it's so many different things, yeah, and that's the danger with a word like digitalization. It becomes sometimes a bit of a a bit of a buzzword, and sometimes we can use it and mean different things. But one thing that I'll say is, as a kind of broad integrated company, a lot, for example, that we see in digitalization is first of all on the customer end, right? How do we interact with customers? How do they buy our products, etc.? We see that fundamentally changing and using different digital things for that. Sandy mentioned earlier data. That's absolutely critical. How do you actually harness data, understand it, put kind of smart algorithms, AIs, others to work on top of that data. I'll give some small maybe examples to bring it to life. We used, we have these drones that fly around our refineries, and we combined that, the images that they actually have with facial recognition software to be able to predict with a 95% certainty as it goes around miles and miles of kilometers of pipes that you have in a refinery where we have, upcoming corrosion defects, right? So these are the kind of things where you tie these different things together and can really do some pretty good stuff. We have so much data in our industry that's just a mess. I mean, I'll be honest, in our company, the hard work that starts with digitalization is actually getting a handle on your data and the basics of your data. We hire, young grads nowadays that have degrees such as data scientists, and this and they want to work at tech companies typically. Some of them have come on internships in our company, and we show them what we have in terms of data, and they are like kids in a candy store, right? Because they would never have imagined the sheer amount of data and the opportunity that it gives them, whether it's things like predictive condition monitoring or other things that the amount of data in our industry actually gives them to work on and to do pretty cool stuff, particularly from their perspective. So I think that's another thing that's massively underestimated about our industry, Jonathan.
I'll just say a couple of words. I mean, in our industry, digitalization means harnessing of data and using that data to become more efficient, so that we can do more with less and ultimately grow our business going forward, right? I mean, there's automation, there's IoT, there's AI, there's a lot of stuff out there. It's all going to require investment. That's going to be a challenge in oilfield services, but I think digitization for the oilfield service space is really, it's a catch up to a certain extent, but it is about harnessing that data and extracting the value from that data. So this data science thing that Cedric was talking about, we're already looking at bringing in data scientists into Parker to mine the information that we have. So that's digitization from our perspective. You're muted, John.
I'm so much more intelligent when I'm muted, actually. It's amazing how my IQ goes up. I'm zooming up there at the moment. No, I was going to say there's some outstanding questions that are in the Q&A that have to do with geothermal, have to do with nuclear. And then one of the final ones, which I think we sort of started on, and I'm going to turn it back to Andrew on this and just let him comment. And if you guys would like to talk about it, that'd be great. I do have an earnings call in just a moment, so I'm going to have to log off after this and go prepared for my beating, which is my quarterly, being flagellated here. But one of the questions has to do with how do we begin to teach youngsters, children, and I'm not going to say to be pro oil and gas industry. For a moment, I'm just going to try to be objective and just say, how do we teach them to understand how to formulate problems and solve problems and do that best based on the best data and make the proper trade-offs between short and long term? How do we change the way our culture has become so reactive and irrational to where it becomes more of a a thoughtful society, and that's in every country, as opposed to being driven by social media and outrageous and unfounded remarks. And with that, I'm going to turn it back to you, Andrew, and I am going to say thank you very much. You've been very kind, and I've enjoyed moderating this. It's always a pleasure to work with Andrew and the USRCC. You guys are very good to me and letting me come and listen to these great speakers, and appreciate very much having a chance to be here. Thanks so much, Andrew.
John, thank you very much. Appreciate it.
Bye-bye.
Thank you. Bye-bye.
Let me take a stab at John's question then, Andrew, if that's okay. I think the critical thing is for people to engage, yeah, and to engage into the debate and the discussion, because the energy transition, the challenges, it is deeply complex, and I'm going to actually quote one of global energy CEOs that said, you know, the issue is extremely complex, and unfortunately the answer does not fit into a Twitter message. Yeah. And I think that's fundamentally the way what I would look at it. Unfortunately, that it is just not that simple that you could Twitter it and then, oh, yep, we've got it. So for people to really understand it, I think what they need to do is engage in that debate, and then they'll have a better understanding of actually the complexity, what's possible, and how many things are possible if we do it together, but also how many of those possible things are needed in order to get to the answer that we all want.
Yeah, I'd like to just add on to what Cedric just said, because I think it's also important. When we have this dialogue that he's alluded to, you know, the thing is that we got to have both parties around the table that are not shouting at each other, because what I found recently, it's over the last couple of years, and that's what I mean by recent, is that the anti-oil and gas message and their voice is becoming stronger and stronger and stronger, and you don't really have a dialogue. You have people shouting at you, and everywhere you go, and it's one of those situations where I think if you had sort of more level-headed discussions, you would find out that the oil and gas industry has moved dramatically to the center in terms of what it's done in terms of environmental control, climate change, you know, and we're willing to make this discussion. And I said it, you know, in London this year when I was speaking at an event, I basically said it sounded like an Alcohol Anonymous conference, because everybody in front of me was apologizing for being in the oil and gas industry, and they were apologizing to the people that were in the oil and gas industry. There was like nobody from the outside that was basically there to really listen to this particular message. And so, you know, I think, you know, right, you know, Sandy said the message has got to be better. But I think we also got to get around the table where it's not a hot-headed yelling discussion, because I think the industry has done tremendous things over the years to better clean up the industry. And yes, there's been faults. I mean, everybody recognizes fault, but I also think with what Cedric mentioned, often overgets looked. I mean, think about the billions of people over the years, over the last 100 years, that we brought out of economic poverty. And like you said, there's a billion people that still need to have energy. There's 800 million people in the world that still cook food off of wood and dung. You know, I mean, there's things that the industry really needs to find solutions for to better the economic prosperity of many people who are really what we would consider to be the less fortunate or developing nations today. So I think the message could be really good. We just got to find that voice, and that voice is missing. And I think that's our biggest challenge right now in getting this point that John ended his poem on.
Andrew, just want to thank you and the U.S.-Russia Chamber of Commerce for being able to engage today and have this conversation together. I have a different commitment as well, but I think we're at roughly at time anyways. But certainly.
Well, I would like to also to thank you, Cedric. Would like to thank Mark, Sandy, and Matthew. Outstanding panel today, and also outstanding moderator with John Gibson as well. These are all the topics that are very important right now for U.S. oil and gas industry as well as Russia. And I think one thing that I got from it that we need to continue with energy dialogue. And we're probably going to continue with, part 2, part 3, etc. The message that we have is not only educating the young generation, but also spreading the word about the benefits of oil and gas and energy industry to the world. And I think the more we send the message, the more people understand the benefits, and it also will add to the support of the political discussion as well. With that, I would like to thank again our panelists, would like to thank our audience for your questions. There may be a couple that haven't been answered, but we'll answer them in due course. Thank you very much and have a wonderful day. Bye-bye.